Hey, what's going on everyone? It's Griffin here, and in today's video, we're going to be covering 4 Canadian dividend stocks that I personally hold in my portfolio, some of which we have not spoken about in a couple of months. So this is going to be a great update for those who are asking. If you're new to dividend investing, well, these are some of my top Canadian income generating positions, and if you've been around the channel for a while, well, some of these might actually be familiar. However, it's just as important to revisit and reanalyze the opportunity that certain companies are now providing in the present moment, just as much as it is discovering new positions. Again, if you're newer to investing, well, a dividend stock is quite simply the stock of a company that redistributes a portion of their earnings back to shareholders in the form typically of a cash payment. And this can be for a variety of reasons, but usually this is just as a reward to investors for holding shares of their company. And of course, not all dividend stocks will be equal. And so some of the preliminary criteria that I look for in a quality dividend stock include the following. First off, I like to see a stock that has a dividend payout ratio of around 50% or lower. Second thing I look for is stability in the dividend payments for minimum usually 5 years. So increases in these dividend distributions for a minimum of 5 years. And in parallel to that, minimum dividend volatility. So huge jumps and decreases in the payout to shareholders on an annual basis. And then finally, I like to see dividend stocks that have a dividend yield of at a minimum around 3% up to around 5%, but all of this is in relation to healthy underlying financials for the company. Now, these of course are malleable conditions, and not all quality dividend stocks are going to fit within this mold. However, they are preliminary things that you can look for when searching for new positions and dividend stocks to maybe add to your portfolio. So with all that said, let's get right into today's first dividend stock on the list. All right, so this first Canadian dividend stock is one I have mentioned quite a few times on the channel, and that's for a reason. It is Granite REIT, ticker symbol GRT.UN on the TSX and GRP.UN on the NYSE. So yes, Granite REIT is in fact a dual listed stock for those who were not aware. And this real estate investment trust continues to be one of my favorite consistent dividend stocks, both for the income and the growth in share price, considering the sector of real estate that the company operates in. Now, over the past 6 months, we've seen the stock continue to appreciate by roughly 18%, which for an REIT is actually significant growth. And this is also considering a recent consolidation of right around 5.3% from its all-time highs of $94.60 in the Canadian markets. So yeah, definitely some nice share appreciation for Granite REIT over the past several months, and that's without even taking into account the dividend distributions, which leads us to speak about, well, their dividend, which currently has a dividend yield of right around 3.26%. The main reason why I like Granite REIT as a solid dividend stock is because of their consistency in dividend payments and increases over time in parallel to underlying financial growth over the same period, all of which is resulting in increased share price as a bonus on top of the dividend income. In fact, it should even be noted that over time, their relative yield has actually declined, but this isn't necessarily a bad thing in the context of Granite, as all this means is that their share price has grown at a quicker pace than their relative dividend payments, even though their dividend payments are increasing. In fact, if we take a look at their actual dividend payments over time, we can see that payments have increased consistently, which is what we want to see as dividend investors. In addition to this, GRT's dividend to funds from operations payout ratio is right around 76%, which might sound high, but consider that this is an REIT that's obligated to redistribute most of their income back to shareholders. So while a target payout ratio of 50% or less is ideal for a typical dividend stock, a target FFO payout ratio below 80% is acceptable for a real estate investment trust. This company's dividend is rock solid, and even during the low point of 2020, they never missed a dividend distribution payment out to shareholders. And in fact, they also have never missed a rental payment collection, that is, from any of their tenants. This is mainly as a result of the nature of the property they hold and therefore the nature of their tenants, which is the second reason why I really like this company. Basically, this company has a strong history of growth in top line, bottom line, actual asset value, and shareholder equity, along with funds from operations, all because of the nature of their tenants, which are industrial tenants spread across North America and Europe that aren't nearly as impacted by the sways of the economy. For example, some of their tenants include Amazon, Magna International, DHL, and Wayfair, just to name a few, which are quality tenants. All in all, I'm a real estate investor myself, but have no physical exposure to industrial property. So this is why Granite REIT is my company of choice, and they just continue to deliver quarter after quarter. Their Q3 2021 figures are expected to be released on November 3rd, so let's definitely look out for those as shareholders. But I expect growth across the board as they've been continuing to acquire new industrial properties and expanding their tenant base. Moving on to dividend stock number 2 here. This is also one of my all-time favorites in the Canadian space, and this is a telecommunication company. You may have guessed it, it is TELUS, ticker symbol T on the TSX and TU on the NYSE. So again, another dual listed stock for any American viewers. Now, TELUS stock has had a relatively nice run over the past year, reaching top growth figures of right around 25% at its 52-week high, but has since consolidated down by a pretty rough 8%, making this, in my view, a nice opportunity to continue buying in and averaging into this long winning dividend stock. The thing about a telecom company like TELUS is that although there are new competitors entering the space that will undoubtedly disrupt the industry moving forward, well, TELUS has a massive footing in the Canadian telecom space with over 12 million customer connections across wireless, residential networks, internet, and television, which has helped the company maintain steady growth in underlying financials. In fact, Q2 2021 was the company's best ever quarter from a top line standpoint at over $3.3 billion in quarterly sales, bringing their trailing 12-month figures to over $12.6 billion, which is a 14% year-over-year increase. For a telecom company of this size already, that is stellar year-over-year growth that can't be overlooked. Now, from a business expansion standpoint, TELUS has also recently invested $1.9 billion to establish its 5G network expansion and has continued rolling out fiber optic lines to homes and businesses to remain competitive in the industry and serve the ever-growing need for increased broadband. Now, taking a look at TELUS's dividend, we can see that considering the current share price for the company, they have a dividend yield right around 4.6%, which is extremely attractive for dividend growth investors, as the company has a solid history of biannual dividend increases for now over 17 years, with what looks like will be increases in the waters of 8% for 2022, significantly outpacing inflation. With that said, when taking a look at TELUS's dividend payout ratio, one could be quite alarmed, as this figure does exceed 100%, which again, in most cases would be a huge red flag. The reason a company like TELUS or Enbridge, though, can maintain high payout ratios, even exceeding 100%, is because of their high levels of free cash flows. In fact, TELUS's management has even addressed this issue specifically, stating that they have raised their target guideline as 60 to 75% of free cash flow on a prospective basis. All of this to say that TELUS will certainly not be a massive growth stock by any means, but that's not the goal of holding a stock like TELUS. Rather, this is a great defensive stock on all accounts with a resilient high dividend. All right, hopping into stock number 3 for today, we have one of my favorite Canadian bank stocks, and that is TD Bank, ticker TD on both the TSX and the NYSE. I'll keep this one relatively brief, as TD is well known for being a quality Canadian dividend stock, but currently it has a dividend yield of 3.66%, and with growth of roughly 42% over the past year, TD continues to represent a great dividend stock. It's actually pretty incredible to even think that TD stock reached the low $50 per share range in 2020, but with the economy bouncing back, banks managed to significantly lower their provision for credit losses, which had severely impacted their bottom line figures. By the way, provisions for credit losses were essentially money that these large banks were putting aside to account for possible future loan defaults in the event of a catastrophic event like the pandemic. However, in reality, the negative financial repercussions were not nearly as catastrophic as accounted for. Now, over the past 5 years, TD has managed to consistently increase their distributions by a minimum of 3% annually, now translating over to a dividend payout ratio of 47%, which is adequate for a dividends forward maintenance. Now, although the stock has appreciated quite a bit over the past year and has actually also been trending sideways for a little while, with a PE ratio of now 10.2, this places it as the cheapest of the large Canadian bank stocks and just above its 3-year average PE value. Now, over the next year, with talks and plans of slowly re-increasing the baseline interest rate of the economy, theoretically this would be actually beneficial for a bank like TD that derives a large portion of their income from interest on certain loans, such as mortgage loans, as well as basically any other loan that the bank lends out. Overall, based on what I could gather from TD's Q3 financial figures, this is a bank that's in a healthy financial position and that should continue being able to expand their reach and customer base, ultimately all beneficial for growth in share price as well as dividend increases over time. And finally, the fourth and last Canadian dividend stock that we're going to be speaking about in today's video is Power Corporation of Canada, ticker symbol POW on the TSX, and in the US it trades on the OTC market under the ticker PWCDF. Essentially, Power Corp is a management and holding company that operates in North America, Asia, and Europe, with core holdings in the insurance, retirement, and wealth and investment management sectors. The reason why I believe this is a great dividend stock, though, is because of this company's massive web of services and stakes in many other operating companies, all of which have allowed this company to offer a nice yield, currently sitting at around 4.2% and a low payout ratio of only 45%. In fact, Power Corp has the following interest in each of the organizations on this chart, with 100% interest in Power Financial, which has a market cap of $22.7 billion, and Power Financial holds 66.7% of Great West Lifeco at a market cap of $36.1 billion, meaning that just in relative value, POW's stake in its operating companies has a higher market value than its own market cap. Power Corp also holds a controlling interest in Wealthsimple, which I'm sure you're quite familiar with as a disruptive Canadian fintech company that's seeing nothing but massive growth. POW's PE is also quite low at 10.8x, which is lower than the overall Canadian market at around 13x and is in line with its own average PE over the past several years. So yeah, POW is a stock that I hold actually in 2 dividend stock portfolios, and I just see this as a consistent and steady company both for share appreciation over time as well as increased dividend income. But make sure to let me know what you think of Power Corporation of Canada down in the comments. And with that said, this pretty much wraps up today's video covering 4 Canadian dividend stocks, most of which are they're all dual listed on American exchanges as well. I really hope you enjoyed it. If you did, make sure to smash the like button, it really helps the channel out, and also check out all the other videos that I've already posted about dividend stock investing, as well as just stock market investing in general on my channel. There are over 100 videos about this very topic that I'm sure you will enjoy. If you'd like to learn more about dividend stock investing, then I'd also highly recommend you check out the first link down in the description where you can get 25% off my full stock market investing course, where you'll get everything you need to know about how to properly navigate the markets, understand what you're looking at when analyzing a stock, and ultimately craft a portfolio suitable for your needs as an investor. So with all that said, thanks a lot for watching today's video, and I will see you in the next one.